Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's show, fund manager Marcus Bogdan of Blackmore Capital tells us why he's positive on these stocks, Healius, CSL and Brambles and Suncorp, but he's negative, believe it or not, on CBA. The former head of New South Wales Treasury, Percy Allan, talks about how he times the stock market for bull markets and bear markets and when he wants to get out, and what he's seeing in his economic crystal ball when it comes to where the market's heading. Then Ying Yi Ann Cheng of Coolabah Capital explains why the experts in the money market think interest rates could rise for homeowners sooner than the Reserve Bank's 2024 call. And then Slater and Gordon's Rohan Foley explains why they want, that's the lawyers, they want to take a casino business, Star Entertainment Group, to the cleaners with a class action. That's the show up ahead. And let's kick off with Marcus Bogdan, who I caught up with earlier in the morning in my office. Well, joining me now is Marcus Bogdan, who is from Blackmore Capital, and he manages the Switzer Dividend Growth Fund. We always like to see what dividend-paying stocks or potentially growth-growing stocks are in favour or out of favour with Marcus. Thanks for joining us, mate.
Thanks, Peter. Good to see you.
Okay, mate, let's talk about some companies that had some interesting revelations, and Healius is one of them.
Yes, well, they've had their AGM this morning, and just to remind investors, Healius is the second largest pathology provider in Australia. It also has diagnostic and short stay hospitals, but pathology is the core business, and it's recording record levels. And no doubt that that's been driven by COVID testing. They're doing about 40,000 tests a day at $100 per test. But the revenue for the first quarter vis-a-vis the previous first quarter was up 44%, and earnings were up 159%. So well supported by COVID testing, but equally important, they are starting to see a recovery in their base pathology business, which is trading ahead of expectations as well. And so that's led to a nice uplift in their share price today of around 5%. And I expect to see some significant upgrades on the back of their announcement earlier this morning.
Marcus, did you buy this for growth or did you buy this for dividends and the growth is just a nice bonus?
No, bought it it was a recovery play. We could see that the underlying business was improving. They'd simplified their corporate structure. So we saw it both in terms of an earnings recovery play. It is in essential industries, which we like because of the stability that generally gives to earnings and dividends. And also with the selling of their general practice business, they have ungeared their balance sheet, which has allowed for on-market buybacks and a higher uplift in dividends. So really buybacks, earnings growth, and an uplift in dividends as well.
And does it mean they have to deal less with troublemaking doctors?
Yes, no, pathology and diagnostics is far more automated than general practice, and hence a more attractive business model.
Yeah, I love doctors, but they're not always the easiest to boss around. Let's go to CSL. There's some news there.
Yes, so CSL earlier this week had their R&D Investor Day. And that highlighted that they have got a very nice suite of products going forward in terms of new disease therapies. They've got 6 new developments which will hopefully come to fruition over the next 5 years. But CSL has got a very strong track record of delivering on these new projects. So if you go back 5 years and those projects that came to fruition 5 years ago, they now represent 20% of the earnings base of CSL today. And so whilst this year is modest growth because of the impact of COVID, we do expect that CSL will return to double-digit earnings growth over the forecast period. And that will also lead to a double-digit increase in distributions or dividends over that period of time as well.
Yeah, but you don't buy CSL for dividends, really. You buy it for the growth.
Absolutely, yes.
My best guess is I wouldn't be surprised to see CSL at $330 over the course of the next 12 months. Is that too courageous a call, do you think?
Well, no, look, they have been at those sorts of levels previously, and I think you're going to be at a much higher level of earnings, and the expectation that they'll be able to maintain those earnings over the forecast period. And so I think for all of those reasons suggests that there's still, 10 to 15% upside on our base valuation.
Great stuff. Okay, let's go to Brambles now. Brambles has been a bit of a troublemaking company for lots of investors because it's a good company, but it doesn't always come on song when you want the share price to rise. What's the news coming out of Brambles?
You're absolutely right. And look, Brambles and that CHEP model has been in Australia since the 1950s, and they've subsequently expanded, and they're one of the largest logistics players globally now, with their biggest markets being in the US and Europe. And you're absolutely right. It has been a frustrating stock to follow over 10 or 15 years. But the actual underlying business franchise is incredibly strong and incredibly stable. It supplies, the bulk of their business is supplying into consumer staples globally. And they have had recently a pullback in their share price because of a recent trading update, which has suggested that profit growth wouldn't be as high for this year because they're reinvesting back into the business in terms of both their digital application and automation. But their first quarter result, which they released earlier this week, was actually stronger than expected. Revenue growth of 9%, which was ahead of their guidance for the full year of between 5 and 7%. So the share price has come back over 10% in recent weeks. And now I think that now is representing reasonable value in a franchise which is stable and growing over time.
Yeah, okay. Let's go to the last area, and you've reduced your exposure to one of the best banks in the world, let alone Australia, namely CBA, and you've increased your holding of Suncorp. Why?
Well, CBA's had an incredibly strong run. It is the premium bank in Australia, and we still like it in terms of its delivery on both earnings and dividends, and it has got the strongest balance sheet of the four retail banks. But I think the valuation is certainly up at the upper end, and we thought that it would be prudent to take a modest reduction in our weighting in CBA and put that capital into Suncorp, which we've done very well with that investment. So that's both a bank and an insurer. But by doing that, we're actually lifting the dividend yield from, circa around 4% in CBA to over 5% for Suncorp. So we're just giving a little bit of a kicker for the dividend for the fund.
Great stuff, mate. Thanks for joining us. Talk to you in a few weeks' time.
Terrific. Thanks, Peter. Cheers.
On Wednesday, in my podcast, I interviewed Percy Allan, who is a former head of New South Wales Treasury. And Percy's become a bit of a stock market enthusiast, working out in ways in which you can time the market. And there's a longer podcast for about 30, 35 minutes. But I wanted to pull out one part of that interview, which I'm going to show to you right now, about what Percy's seeing with his economic crystal ball in terms of where the market might be going in the short term and the long term. So this is Percy Allan.
In the market, in many ways, is the best leading indicator of the economy because day to day it reflects the sentiments of investors. And so it's a terrific leading indicator. But then around that, you can talk then about why is investor sentiment changing, and that comes back often to two fundamentals.
Yeah.
Although rationality isn't always, it doesn't always predominate. So irrational factors can come in too.
I must admit, over my lifetime, Percy, I've realised that no one can be accurate in tipping where a market's going. But I have found that if you put the consensus of very, very good market analysts together, you often do get warnings. Warnings in the past when I was young and stupid, I ignored, but ones I think make me a little bit more cautious. And so if caution leads to a more defensive spin on my portfolio, invariably I can soften the blow when those crashes come. But some crashes are often a bit tricky.
It certainly is. I mean, when I look back at stock market crashes, leaving aside the pandemic, which was a black swan, and it suddenly came, but obviously the smarties could see that once it hit Italy and Italy virtually closed down, they then, amongst themselves, said, why should it stay in Italy?
That's right.
Why shouldn't it hit Europe, America, Australia? And then they started exiting the market after February the 20th last year. And boy, did we have a crash. I mean, we were down 37% through the whole. It wasn't as bad as the GFC when we were down about 55%, but it was a bad crash, but we bounced back quickly. But two things normally bring crashes, either energy prices or interest rates. And we know inverse yield curves, and when the short-term interest rates overtakes the long-term interest rates, that's a very dangerous signal. But that doesn't exist at present. And the other one is energy prices, which are at present taking off. So that's one really to watch, I think, too, at present. The interest rate one, possibly with quantitative easing being tapered, we could see the long-term rate going up, and that would have an effect on the market. So I think at present the market's a little nervous in that how far will quantitative easing, quantitative tightening go? And the other one is how far these energy prices will go. Is that just a temporary blip? If so, we'll get over it. And they seem to be the two big things. There's lots of other things like the Chinese property bust that's happening. Yes, that could impact Australia more than others. There's other things like the American debt ceiling. Will they usually get over that one? And it's within the control of the Democrats to fix that. There's also just the risk that the COVID could come back. We're learning now that we all need booster shots because the vaccine wanes after 6 months, and isn't that effective? So governments need to roll out those shots again next year. And so there are always these imponderables, but I think the two big ones we're really all watching are interest rates and energy prices, because traditionally they've been the ones that have undercut the market. Okay,
so let me share with my viewers and listeners your current view from your newsletter, and you're basically saying that the short-term view looks bearish, but the medium to long-term looks bullish. Is that the right interpretation?
Well, it was till yesterday. As I mentioned in the newsletter, it could change this week, and it has. Today, on our short to medium-term model, the market's bullish again.
I was hoping you'd say that because that was my best guess as well, but I wanted you to agree with
this. You timed this interview perfectly, but I just checked the market before and I thought it would happen yesterday or Friday, but it's happened today. Effectively, the 10-day moving average or trend line of the market has overtaken the 30-day trend line, and that's a really good sign. Long term, it's very bullish, although it's showing some fatigue. The COPOC indicator has flattened after the bull market since last year, since March last year, which suggests the market is taking a breather in a long-term sense. Now, whether it'll then keep going up or whether it'll turn, I can't tell. But both are looking pretty good today.
Yeah. And your medium to long term was looking good. Explain to my listeners and viewers why the medium long term looks good.
Yeah, look, we did a lot of model testing, and we came down really with two indicators, which we think basically tell the whole story. We could add a whole lot of other indicators, but they didn't add any value. One is to take the 30-day trend line, moving average of the All Ords index. The other one is the 300-day trend line. And if the 30-day trend line is above the 300-day trend line, then it's really telling us over the long term the market is bullish. It's running ahead of itself.
Yeah.
On the other hand, if the 30-day trend line falls below the 300-day trend line, as happened last year during the crash and happened during the GFC, but this is a slow-moving model compared with the shorter-term model, then you know you're in a bear market, and you have to wait for that 30-day trend line to again move up above the 300-day one. At the same time, we look at the COPOC indicator. The COPOC is remarkably accurate in Australia's case. It's almost at 100% accuracy. I think it's at 100% accuracy. In other markets, about 70%. But when the COPOC indicator bottoms, it gets into negative territory and then starts turning up. At the point where it starts turning up, you pretty well know that the bear market is over. And that happened pretty early last year after the crash.
So how long before you get good signals with COPOC? Like, for example, at the moment, COPOC has been rising because we're in the bull market. I think it has leveled off a little bit, hasn't it, in recent times?
Yeah, the COPOC we've got to be a little careful with. It's really only a signal for the end of a bear market when it bottoms in negative territory. The experts in this say, look, where it tops can be unreliable because it can have a top and then go down a bit and keep going up.
Well, I was going to ask that question, yeah.
And that's happened often. But when it gets negative and bottoms, it's very rare that it doesn't keep going up again. Yeah. So it's a very reliable signal for the end of a bear market. It's not that reliable a signal for the end of a bull market, although when it starts flattening out, as it's doing now, it may signal the end of a bull market, but it may also just signal the bull market's having a breather before it takes off again.
Yeah, so therefore, the fact that I use my gut feeling and history to buy a whole lot of stocks at the bottom of this most recent collapse of the market, I should have just gone to your COPOC. That would have actually confirmed I was right. I could have doubled my purchases.
Well, the COPOC, I mean, doesn't bottom exactly at the bottom of the index, right? Yeah. I think it bottomed in about, I'd have to check the data, but it was either May or July or something like that, May, June.
So there's
3-4 months delay, but still, if one had bought in at that point, you're right. One was buying in in a depressed market. You wouldn't have been buying in at the very bottom of the market because it's a trend following system. And with any trend system, there's a lag.
Okay. Now, you know, I always try and marry the stuff that you do with my economic assessments as well. And I interviewed Bill Evans last week. I'm sure you've come across him in your time. And Bill thinks, and Bill thinks the Australian economy is going to grow by 7% next year. That's a huge number, isn't it? 7%.
Yes, he's very bullish.
Yeah. So
I think 7% next year, Peter. I think he's got 0 for this year, which no one else has. Yeah. And I think when I last looked, and he had about 7% for next year. So it's a massive turnaround, but more than any other economist out there. But he could be right. I mean, it depends what happens in the December quarter, whether we still get pretty flat growth or negative growth.
Yeah. So I guess my discussion point is this, that if we have an economy growing at 7%, would you then think that would factor into pretty good Australian company profitability and therefore be a nice base for share prices to keep rising over 2022?
Well, one would think so. We've had a pretty rough journey last year, and then we thought we were out of it, and suddenly Delta arrived, and that dreadful strain of COVID, and we're back in lockdown, and things really got worse. And so we've been sort of through 3 waves of this COVID, and hopefully the worst is over. And so the positive things for the market is that there is some slowdown in world growth, I think, happening. And as a result, central banks may not may not start quantitatively tightening as fast as we thought, and interest rates may stay reasonably low. I think we're in a bit of a fragile period. So interest rates may stay low. If at the same time the economy does recover, and if Bill's right, and we have such a strong recovery, even if it doesn't happen in other countries, or although the OECD is not as optimistic, then yes, the outlook for companies and others should be very good. I mean, we're coming out of a bleak period, 2 years of a bleak period. People are getting back to work, and the economy is regenerating. So it should be a good year by all accounts. It's not to say there aren't problems, but I can't believe we're going to have another bleak year because the pandemic's out of the way, and it would have to be something else, like a sudden jump in interest rates because central banks put the brake on their quantitative easing in a big way, not in a soft way, or suddenly energy prices, instead of subsiding, kept continuing.
Yeah. Well, last week when Bill finished off, I reminded him that he was a board member with the AJC, and I asked him for a tip from the Everest, and he came up with Nature Strip, which actually won. So I'm not going to locate you to the racing industry, but what is your investment best idea for 2022?
Oh, dear Peter, I've got to be careful. I don't have an investor's advisor's license anymore. I can't really enter into that.
Just say, I know you'd often play the market via ETFs, don't you? That's one of the strategies that you use.
Look, I'm not terrific at guessing the market. What I can do is tell you where the trend is going and so forth, and I can talk about the economic parameters. And usually the trend's your friend until it bends, as they say. And at present, the trend is pretty friendly with stock markets. I suppose when I look at my own investments, I ask myself, going forward, what's likely to happen? I think the American market is dreadfully overvalued on fundamentals. On the other hand, if we're in a very low interest rate scenario, the American market's very cheap. It's called the beer ratio, the bond to equity return ratio. And equity returns are still much better than bonds. And so on that basis, it's one of the cheapest markets that we've had in history. On the other hand, if you look at the Shiller ratio, which is a kind of a variation on the price earnings, it's dreadfully overvalued, the most overvalued market in the world. On the other hand, other markets outside America are a little overvalued, but they're not greatly overvalued because they're not as much into high tech. A lot depends on high tech. But I think at some point there will be a rotation from value to growth. I mean, historically, value now, it looks very cheap. You have to go back decades, and growth looks very expensive. So some point, and I keep buying value shares, and it started looking good last year. Now growth is suddenly back. So, but I still have some faith in value. I once chaired a value manager, and value was always the winner until the last 10 years. Growth has been the winner. I suppose the other one is, I think, a rotation perhaps out of America to other markets like our own and emerging countries and so forth. Now, sure, if the future is all about high tech, then maybe America will continue to dominate. But I think what's happening is all industries are now becoming high tech. They're having to be. And I think Australia, Europe and others are catching up. Their high tech is going into what are value industries, if you like. They're almost becoming more growth industries. And so at some point, a rotation out of that dreadfully overvalued American market, which keeps going up, into, particularly the NASDAQ, into other countries and their stocks as they take the technology on board. I think that's also due. So there'd be two themes, from growth to value and from America to other markets.
Percy Allan, thanks for joining us.
You're welcome, Peter. Always fun.
We're being joined by Ying Yi Ann Cheng from Coolabah Capital. We're going to talk about what's going on with interest rates. And if you take the indications from the Reserve Bank in its latest minutes, you have to say not very much at all. Ying Yi, great to see you.
Great to see you, Peter. That's right. That's right. Yeah, look, I mean, if anything, the market is clearly sort of ignoring what is a very, cautious RBA, given their rhetoric around, global trend towards withdrawing policy support. So, the RBA's view is that the cash rate is likely to remain on hold until 2024, given an expected slow recovery in wage growth and inflation. Now, the RBA does definitely sound very adamant compared to its global peers, whether it's in New Zealand, England, or even the Fed for that matter, who is likely to raise rates next year. And obviously we've already started seeing, hawkish moves from New Zealand and England already. But the RBA seems to be quite adamant that they probably want to be the last central bank, at least of most of those developed economies, to make a move. Our view is that the RBA will likely hike rates in 2023. For now, from a domestic point of view, there's no sort of signs of inflationary pressure compared to, say, our offshore sort of peers. So yeah, it gives us some food for thought there.
Yeah. Yes, Ying Yi, I interviewed Bill Evans from Westpac last week, and Bill quite surprised me by saying that he thought that 2022 is going to have a 7% growth, which is big, which is very big. And given the fact that you kind of think the first half of 2022 is going to be slower than 7%, the second half, to me, says it's going to be really, really fast growth, which means that the 2023 call on interest rates by you guys seems far more believable than 2024.
Yeah, that's definitely sort of the case. I mean, look, I think the RBA themselves are quite optimistic about economic recovery, and that's because, you know, we have New South Wales reopening, we have Victoria reopening as well. So there's a lot of pent-up demand that will likely sort of take place, and obviously, you know, that will be very, very good for consumer spending, and you know, consumer spending, and also businesses as well. You know, not having the issue of knowing, oh, okay, when we get another lockdown, like when will we get another lockdown? So I think that will be good from a business sort of borrowing sort of perspective, and broadly for economic activity. However, the RBA is laser focused on wages and inflation, as we've spoken about many a times, and that as an indicator still remains subdued. And our core view is that once borders do reopen as well, that influx of skilled migration that at a federal level that Scott Morrison and Josh Frydenberg are very concentrated on, and also the New South Wales Premier Dominic Perrottet, very focused on bringing in that skilled migration, that will have the effect of putting downward pressure on wages. So that will work, you know, against the view, at least in terms of pushing the RBA towards rate hikes.
Do you think, deep down, the RBA, if it can see house prices slowing down, they'll rise next year, but I presume at a slower rate, that they would like to keep interest rates as low as possible to even keep the dollar low, because a low dollar is very good for economic growth?
Yeah, definitely. There are definitely key advantages in having a lower Aussie dollar and keeping long end rates low. I mean, that was the whole point of them really trying to use or go down the QE avenue to make our exporters more competitive. However, with respect to sort of housing, look, I think what would actually be good and is likely to eventuate is that the banks will likely do out-of-cycle rate hikes. So that will put some dampening pressure, firstly, on the housing market, which, as we know, has been strong, but that pace of growth in itself has probably slowed down a bit since March this year. However, you know, the banks themselves, and this is more of a technical thing that we've actually been trading at Coolabah as well, is simply that the banks, from what we know, have to issue quite a lot of debt going forward. So typically in the last sort of 10 years before March 2020, they would typically issue around $140 billion worth of debt to maintain their maturity profile as part of their issuance program. We actually think that number is going to be closer to about $170 to $190 billion a year. Now, the banks themselves have been very lucky because they've been able to enjoy very cheap money by borrowing off the RBA via the Term Funding Facility. Yeah. That facility is now over. As we know, the RBA decided not to extend that. And then at the same time, we also have a separate dynamic that has been a theme of the Coolabah portfolios, is that APRA has also recently announced that the CLF, which is a committed liquidity facility, will now be shut down by the end of next year. That committed liquidity facility has, in a nutshell, allowed the banks to hold alternative liquid assets as a form of emergency liquidity, as an alternative to government bonds. Now, inside this facility, the banks have been able to hold their internal loans. They've also been able to hold each other's bonds. So this bank senior bond. Because this facility has been closed, banks themselves will no longer be the largest buyer of each other's bonds anymore. Wow. So the cost of borrowing for the banks, therefore, since there is no sort of, regulatory arbitrage sort of a need to hold this, the banks will need to be forced to pay a higher rate of funding. And that higher rate of funding, guess what? Finds itself towards the end borrower at the end of the day. So mortgage rates, we would expect the banks as a result to be doing out of cycle rate hikes because their own cost of funding is going to be reflected.
So the big story is, just in case people weren't smart enough to understand the highbrow explanation, a brilliant, albeit brilliant explanation, is, and you gave us the clue earlier, out of cycle interest rate rises. So even though you might say, okay, the RBA might not raise until late 2023 or 2024, to the normal borrower, it might not matter because the banks might raise interest rates at the end of 2022 or 2023.
That's right. They could raise, next year, early next year, for example. And then the other thing to also consider is that APRA has been, looking at the housing market, and they're quite concerned about the serviceability of all of these loans. So in the past, we know that APRA engaged in macroprudential policy to put a halt on the housing market, and they were most concerned last time with, investor loans. This time, it's not so much the investor loans that they're concerned about. It's more broadly speaking, the serviceability of these mortgages, given that we are at historically very low rates. As those rates move higher, are these serviceable as a result? So we'd expect that sort of macro proof to also, again, have the effect of dampening the housing market.
Okay. Well, I think you've given us enough scary food for thought.
Not to be scary.
The thing is I think a lot of people have presumed that the banks would only raise interest rates if the Reserve Bank did. But the point you made is, no, they might have to raise before the Reserve Bank.
That's right.
Very scary, but very interesting. Thanks for joining us, Ying Yi.
Thank you, Peter.
Well, in recent times, Star Entertainment Group got ourselves in a bit of trouble and the stock price fell. To talk about that instance of troubles for Star, we have a lawyer from Slater & Gordon, Rohan Foley. Rohan, thanks for coming on the program.
No problem. Thanks for having us, Peter.
All right. So why don't you tell us why Slater & Gordon is interested in the trials and tribulations of poor old Star?
Sure. I mean, I don't think we would call it poor old Star, but
I'm being generous, Rohan.
Certainly, we're currently investigating a class action against Star in relation to the matters that were disclosed recently through 60 Minutes and Fairfax newspapers. Obviously, many of your viewers will be aware, either peripherally or personally, that the share price dropped about 20% in response to that information. We haven't issued a proceeding yet, but we're certainly investigating whether those shareholders may have claims against the company for failing to disclose material information dating back some years, and further that there may be misleading statements made by Star throughout many of its ASX announcements dating back again a number of years.
Okay, so what does an investigation entail for you guys?
Sure. So a lot of work, for lack of a better word. We look sort of quite closely at the announcements made by the company and the factual circumstances surrounding those announcements and any information that may have been known by the company. So a wide range of exterior resources. And we do that over some weeks to determine whether we have a proper basis to issue a proceeding against the company on behalf of shareholders.
Has there been any evidence of a regulatory body being interested in the behaviour of Star until recently?
So certainly I think Star is the subject of a number of ongoing reviews as part of its licensing arrangements. They happen independently, internally, and also through the regulator, the casino regulator, and AUSTRAC. AUSTRAC announced, or rather did a media release, that they were looking into Star some months ago, and Star did announce that to the ASX. What it didn't announce was we will likely say the underlying metrics of the material which the review was likely to find. So a lot of that was aired through the media reports recently.
So ultimately, before you proceed, do you have to get a substantial number of shareholders saying to you, yes, we're interested in joining the action?
So these days, we don't sort of require, in the same way that perhaps we used to, a certain sign up. We undertake our own analysis of what we think the likely number of affected individuals will be, and then we proceed on that basis. Currently, we're encouraging people to get in touch with us and register their interest, which is just a helpful way for people to stay informed about the progress of the claim. Those people will be notified even when a claim is issued, and any steps from there. There's a number of ways to participate, whether you do that through registering with the claim when it's proceeded, or through a court-ordered number. But it's not so much a case of us needing to, have a certain amount of people get in contact with us. No, we're likely to proceed based on the strength of the claim.
Okay, so I presume then, let's imagine that you and your team go through reams and reams of reports and whatever, and in the end you identify at least 5 or 6 areas where the company has clearly misled the market. So if, for example, no one's contacted you for support, would you still go ahead with it anyway?
We need to the structure of these claims involves at least one person signing on as what we call the representative applicant. They represent the entire group, and we take specific instructions from them. I can't think of an instance that not a single other person has been in touch. Usually, in these cases, there's thousands and thousands of people affected, and they're not shy to come forward and express that. And we've certainly had people be in contact with us already.
Yeah, I would presume so. But it would seem to me that the strength of the support for the class action would come once you reveal X number of reasons why this looks like a case that could be won. Is that true?
Certainly. So there's a few different, I guess, waves of sign up and support that we might get during these processes. Initially, there's often a response from people just immediately aggrieved at having a significant portion of their self-managed super fund or portfolio wiped out, and that happens often very quickly. And we will keep those people in what we call a registration of interest, and then they're updated. Following that, often these result in filed proceedings, and then we'll get another wave or sort of body of interest of shareholders, both institutional and retail, that are interested in signing up.
Okay. For someone to benefit from any compensation that comes out of their class action, do they have to be registered to be a part of the class action, or are all shareholders entitled to some kind of compensation if you guys win?
So it's an interesting question, and it's a sort of nuanced answer. It will be determined at some point what the precise group member definition is. So it might be persons that purchase shares throughout a specified period, and typically it's someone who had a net increase in shares at some point during that period. So certainly if they meet whatever that final group member definition is, those group members will likely be entitled to compensation through the class action. The courts changing the various times, the specific ways people can register for these things. There's typically more than one way. You can often sign a legal costs agreement with the law firm and or a litigation funding agreement if there's a funder involved. And at that point, you'll sort of be on for the ride for the whole way, and they'll register you at the registration time. Then there's often later, quite a bit later, some 18 months, often a court-ordered registration period in which people will have to come forward to register to receive any settlement outcome. We encourage people to register early because those notification processes are never perfect. Often, someone might not have their updated address on their linked or computer share account, and people do occasionally miss out during that later period. But yeah, there's a number of ways, but people do have to register at some point, yes.
Okay. Now, I don't want to be portrayed as a tightwad, but I'm sure people watching the program, some of them might be. Does it cost them to be a part of the class action?
Nothing out of pocket. So you're never going to be worse off from a Slater and Gordon class action. We haven't finalised the particular way this one will be funded if it does proceed, but typically, as is commonly the case these days, we'll seek what's called a group costs order, which is a percentage approved by the court and finally determined at the end of the proceeding. And that percentage cut, whether it's sort of 20%, 25%, generally, always comes out of the compensation received through a judgment or a settlement. So, for instance, if someone's awarded $1,000 in damages, that they will pay us $250 out of that amount if it's a 25% group costs order, and that will be extracted from their settlement amount before they receive their money. So it's never an out-of-pocket expense.
Yeah. Okay. So I think it's pretty well clear that if someone really is aggrieved about what's happened to the share price and they believe management and the board has misreported over time and behaved badly, it seems logical that they should register if they're not going to be out of pocket.
Absolutely. I mean, I say that to all my friends and family when they get in touch, when they get a notification at some point. What do? I just say, register, you're never going to be worse off.
Of course, it's not advice, is it, Rohan? It's just good general education.
Yeah, it makes sense. I mean, I haven't been part of one, but I would register if another firm was doing it. It makes sense.
Well, thanks for joining us on the program, and we watch with interest how you guys proceed with this.
Thanks very much, Peter.
And that's the show for this week. Thanks for joining us. Remember, if you want to know more about us, you can go to switzer.com.au. And if you want more help in investing in the stock market, have a look at our Switzer report at switzerreport.com.au. Thanks for joining me. I'll see you on Monday night.